Welcome to this week's Q&A. We've got a question this week from one of our viewers in the US. And this particular Australian expat is someone who comes from Sydney. They own their old principal place of residence, their home in Sydney, and that's currently rented out and has a land value in excess of the $969,000 land tax threshold that exists in New South Wales currently in the 23 year. So the question is, they want to buy another investment property in Sydney, so in New South Wales, and it relates to land tax and the impact that will have. And the question also relates to, should I buy a house or should I buy an apartment? So all other things being equal, we need to think about the merits of buying an investment, I guess, far more holistically rather than just from a land tax viewpoint. But for the sake of this question, let's look at that. So you own a home in Sydney and it's worth $3 million, and currently you're already paying land tax because it's rented out, you're an Aussie expat, and it's above the threshold of unimproved land of $969,000. So you're paying 1.6% on the excess. Now, if this person was going to buy another house in Sydney, so land value again would be far higher, the land tax impost could be significant. Let's say the house they're buying has an unimproved valuer general's valuation for the land at say $1 million. They'd be paying potentially an extra $16,000 per annum in land tax on that property. Now, if they were going to buy an apartment in Sydney, the actual land component of that could be substantially less. However, if they're going to buy a high quality, desirable style of investment property asset, perhaps a 3-bedroom apartment, the land value may still be several $100,000, and so the land tax applicable to that at 1.6% becomes a meaningful item that these people would have to think about when they're assessing the viability of their investment. There is, of course, another solution to this conundrum, and that is to purchase their investment property in a state other than New South Wales. So, they could choose Queensland or Victoria or WA or wherever, because land tax is assessed on a state-by-state basis. So thereby, if they bought, say, again, a high-quality asset, a large apartment in one of those other states, they would generally fall beneath the threshold for land tax in that state, being generally around $600,000, and it depends on which state or territory they purchase. But all of a sudden, the actual cash flows and yields and net yields in particular start to change significantly if we look at that from an investment viewpoint. So it's a long-winded answer to what was a short question, but all of these things are really important, and I think that's where people really require a bit of I suppose extra guidance or extra information so they can make properly informed choices in relation to their own circumstances. Now, if you found this of interest, then please subscribe to our YouTube channel and click like. And also, if you find yourself in this situation, have a conundrum about this, then by all means, please don't hesitate to reach out, email us or call us, and we'll have somebody contact you to see how we can assist you with your own personal set of circumstances, because everyone's different. I'm Andrew Unterweger, and I'll see you at next week's Q&A.